The biggest crypto legislation push in years just took a major step forward, and the timing could not be more important. Overnight, the U.S. Senate Banking Committee officially unveiled the new 309-page draft of the Clarity Act ahead of Thursday's markup hearing, setting the stage for what could become the most aggressive regulatory restructuring crypto has ever seen in America. And buried inside the bill are several massive changes that could permanently reshape Bitcoin, Ethereum, stablecoins, banks, exchanges, DeFi, and the entire digital asset industry going into 2027 and beyond. But what's really grabbing Wall Street's attention right now is that the bill appears to lock in legal protection for spot ETF assets like Bitcoin and Ethereum, while simultaneously opening the door for banks to aggressively expand into crypto custody, staking, lending, payments, and tokenized financial products without requiring prior approval. In other words, this is no longer just about regulating crypto. This looks increasingly like the framework for integrating crypto directly into the U.S. banking system itself. And if this passes in anything close to its current form, many analysts believe it could trigger one of the biggest institutional expansions the crypto market has ever seen. Before we break down exactly what's inside the bill and why some people believe this could mark the official end of crypto winter, make sure to like this video, subscribe to the channel, and turn on post notifications so you never miss a major update. Because later in this video, we're also going to look at a brand new warning and prediction from Tom Lee, who now says crypto winter may already be over, and what comes next could be a massive crypto spring, followed by a much larger bull market stretching all the way into 2028. One of the biggest developments in the updated Clarity Act draft is the language surrounding ETF-approved crypto assets. According to the newly released details, any token that served as the principal asset of a spot exchange-traded product before January 1, 2026, would automatically be treated as a non-security going forward. If maintained in the final version, it effectively hardens the legal status of Bitcoin and Ethereum while potentially protecting other assets approved for spot ETFs before the deadline. For institutions, that level of regulatory clarity matters tremendously because it reduces one of the largest uncertainties that has held major capital on the sidelines for years. Another major change involves staking, and this section may end up being one of the most bullish surprises in the entire bill. The draft reportedly carves out self-staking, custodial staking, liquid staking, and third-party operator staking as administrative or ministerial activities rather than securities transactions. Even participation in governance does not automatically classify a token as a security. That's critically important because staking has been one of the most heavily contested areas between the crypto industry and regulators. Instead of attempting to shut the sector down, the language now appears focused on defining how staking can legally operate inside the U.S. financial system. At the same time, the bill aggressively expands what banks are allowed to do with digital assets. Section 401 authorizes national banks, state banks, and credit unions to provide crypto custody, lending, payments, underwriting, market making, and staking services as part of normal banking operations, without requiring prior approval. That's a major escalation from where the industry stood just a couple of years ago, when many crypto firms struggled to maintain even basic banking relationships. If finalized, this could open the floodgates for traditional financial institutions to enter crypto at scale, not cautiously, but competitively. However, the bill is not universally bullish across every segment of crypto. One of the biggest compromises centers around stablecoins and yield-bearing products. The updated language prohibits issuers and exchanges from paying interest or offering returns that resemble traditional bank deposits simply for holding stablecoins. In practical terms, this appears designed to stop stablecoins from directly competing with bank savings accounts. Activity-based rewards tied to staking, governance, or loyalty systems may still remain legal, but exchange-based yield programs would likely need major restructuring. And many analysts already see this as a clear victory for traditional banking lobbyists, who have spent months pushing back against yield-bearing stablecoin products. The bill also appears to address several controversial sections that previously alarmed the industry. Earlier concerns from Brian Armstrong about language that could create a de facto ban on tokenized equities reportedly led to revisions that major exchanges are now more comfortable supporting. Another compromise focuses on protecting software developers from automatically being classified as money transmitters under Section 1960 language, while still preserving enforcement tools for authorities targeting criminal activity. That balance may become one of the most politically sensitive aspects of the final negotiations, because lawmakers are now trying to simultaneously encourage innovation while avoiding accusations that crypto is being given a regulatory free pass. And this is exactly why so many macro investors are suddenly becoming dramatically more optimistic about the next phase of the crypto cycle. Because while retail investors are still debating whether this market can truly sustain another breakout, institutional infrastructure is quietly being built in real time. Regulatory clarity is improving. Banks are preparing to enter the space more aggressively. Wall Street is expanding crypto hiring again. And according to Tom Lee, all of this may be happening right as the market transitions out of crypto winter and into the early stages of an entirely new cycle.
I want to talk about crypto spring and why I believe Ethereum is the future of money. Here are some disclaimers. So let's start with why I believe crypto spring is here. I know that many of you believe we're still in the fog of war, and it is indeed true. The US is in the midst of a conflict with Iran. But what you have to focus on is that Ethereum has now risen for 3 months consecutively. And in fact, if Ethereum closes May above 2100, that would be the 3rd consecutive month. As I'm highlighting here, there's never been a crypto winter where Ethereum has closed up 3 consecutive months in a row. In other words, the fact that we're up 3 months in a row means crypto winter is over. Another way to think of this is to look at software stocks and Ethereum. Both have been highly correlated to each other. And as you can see, software stocks have risen along with Ethereum. In fact, at Fundstrat, software is now among our top sector picks as of May 1. So that gets us to some facts that Ethereum is the best performing asset since the start of the Iran war. It's performing as a wartime store of value. And here's the thing. It's been a great diversification tool since 2016. Take a look at this first column that's highlighted. Let's look at different allocations you could have done in terms of owning Ethereum on December 31, 2016, from 0% all the way to 33%. And these are the starting dollar values. So if you had $100,000, for instance, and you put 5% into Ethereum, that was $5,000 invested. This highlighted column is what it would be worth today. So your $5,000 investment would have grown to 1.5 million. In other words, if you compare that to having 0 allocated to Ethereum, okay, and you look at your total portfolio today, it's 230,000 if you had no exposure to Ethereum versus 1.7 million if you had 5% allocated to Ethereum. In other words, you had a 7 times increase in your total portfolio with just a 5% exposure to Ethereum. Now, another way to think of this is how much of each asset would you need to own to protect yourself against a 50% decline in the S&P 500? Okay, so this is the required hedge. You would need just 0.4% 10 years ago in Ethereum to protect yourself against basically a wipeout in the stock market. Gold, which is considered a store value, you'd have to have 37% of your portfolio. So you can see the point here. You'd want to own just a small piece of Ethereum as a source of diversification and as a hedge. Now, Ethereum does track Bitcoin, so I think you should look at the price ratio. And the current price ratio is below not only the 8-year average, but the 2021 high at 0.087. And you've seen this chart from us before. If Bitcoin gets to 250,000, which we think is fair value in the next 12 months, and Ethereum gets to the 8-year average of the price ratio, that's 12,000 Ethereum. That's a lot of upside from here. If it gets to the 2021 high, that's 22,000 Ethereum. Keep in mind, those are 2 numbers to watch. And if ETH becomes the payment rails of the future, which we believe is the case, that would imply $62,000 Ethereum. So clearly a lot of upside from here. And Ethereum is exiting a long consolidation, something I've talked about before. And you can see this current consolidation is 5 years. But those other consolidations resulted in pretty explosive upside moves. 227 times after the 2016 consolidation, and after the 2020 consolidation of 54x for Ethereum. So I think this next upside is going to be led by tokenization and agentic AI. So let's talk about the future of money. Now, Elon Musk said something pretty profound recently. He says that this future system won't use dollars as currency, just mass and energy. What he's really referring to is that compute and energy are the two scarce assets. In fact, Larry Fink of BlackRock believes that compute will actually become a new asset class and that we'll be buying futures of compute. Reid Hoffman, the billionaire founder of LinkedIn, said that crypto will become critical in an AI world. Okay, well, let's think about stablecoin transactions, which we had said last year was the ChatGPT moment for crypto. And you can see stablecoin volumes now exceed Visa payments. This is according to data from Bitwise. And Grayscale believes that the tokenized market is going to reach $300 trillion as we tokenize real estate, fixed income equities, derivatives, commercial real estate, basically everything. What does this mean for layer one blockchains? Well, this is Ethereum, which is in pink, and the total value locked of tokenized assets. And you can see Ethereum moves pretty closely with that tokenization, meaning that, according to Grayscale, networks that host a large share of tokenized activities may capture a meaningful portion of economic value. In other words, if Ethereum is the leading tokenization platform, its price will go up a lot.
Buy $10,000 of Bitcoin on a regular exchange. It grows to $60,000. That $50,000 profit? You could owe $10,000 or more in capital gains tax. Now do the same trade inside a Roth IRA with iTrustCapital. That growth? Tax-free. You keep the full $50,000. Same crypto. Completely different outcome. iTrustCapital lets you hold crypto in a self-directed IRA, trade 24/7, and secure your assets with institutional-grade custody. You can also hold gold, silver, and stake certain assets. Real U.S. customer support. $100 bonus when you fund through the link below. In crypto, structure beats timing. Every time. Tom Lee is arguing that the entire financial system may already be entering a structural transition. In his view, Ethereum is no longer behaving like a speculative tech asset sitting on the fringe of finance. It's increasingly acting like digital infrastructure for the next phase of the global economy, from stablecoins and tokenized assets to AI-driven transactions and digital payments. And if the Clarity Act ultimately opens the door for banks, institutions, and corporations to aggressively expand into crypto services, then what we may be witnessing right now is the very beginning of a much larger adoption cycle. But according to Tom Lee, the implications go even further than that, because the biggest winners of the next decade may not be today's traditional financial giants at all.
Well, let's bring this all together. If tokenization is the future of assets and money is becoming digital and AI agents are going to use money, well, we should think about what it means for the most profitable banks in the future. Well, today, JP Morgan is the most profitable bank in the world with $59 billion of net income projected this year, almost $60 billion, and 300,000 employees. But let's mix in two new types of companies, Jane Street, which just is a trading firm, and Tether. Jane Street's on track to make $40 billion this year with 3,000 employees, 1/1000th the number of employees at JP Morgan. In fact, Jane Street in the first quarter this year is reporting about $10 billion in net income. That means moving money, which is what Jane Street does, is starting to capture more value than the entire operations of a global bank. Again, going back to this chart, Jane Street makes more money than Bank of America, Wells Fargo, Citigroup, Morgan Stanley, and Goldman Sachs. And then let's look at Tether, which is the largest stablecoin operator in the world. It's going to earn about $15 billion this year with 300 employees. So 1/1000th the number of employees of JP Morgan. These are two new types of financial institutions. Didn't exist 20 years ago. But keep in mind, that's sort of the story, that technology, as it gets introduced to sectors, creates disruption and it reduces the value of incumbency. Now, I'm going to highlight a bunch here. Automobiles. We don't remember any of the horse buggy makers. We only think of the new entrants. With mobile, all these old names really largely don't exist. It's mostly mobile today. In digital media, nobody really remembers names like Hearst, Viacom, News Corp as the giants. They were the giants in their day. Today, it's more Google, Meta, and TikTok. Even more recently, cloud computing. Before cloud computing, there were PC names, IBM, Compaq, Dell, Gateway. They've given away to Amazon, Microsoft Azure, Oracle, Google Cloud. And finally, in EVs, these traditional automakers are still around, but Tesla is far bigger. Markets tend to overestimate the value of incumbency, and it's really the new entrants that capture a lot of that value. Well, what does that mean? I believe in the next 10 years, half of the largest financial institutions in the world are going to be native digital companies, native digital asset companies, many of them in crypto.
Regulatory clarity in the United States is improving. Stablecoins are exploding in adoption. Tokenization is moving closer to the center of global finance. Major institutions are preparing for digital assets to become a permanent part of the banking system, and at the exact same time, some of the biggest macro investors on Wall Street are now openly declaring that crypto winter may already be over. That combination matters because the largest bull markets are usually born during moments when infrastructure, regulation, technology, and capital flows all begin aligning at once. And that's really the core of Tom Lee's thesis here. The future financial system may not be built around the same institutions that dominated the last century. Just like mobile phones disrupted telecom giants, streaming disrupted traditional media, and cloud computing reshaped the tech industry, digital assets could fundamentally transform the banking world itself. In that environment, networks like Ethereum are no longer being viewed simply as cryptocurrencies. They're increasingly being viewed as economic rails for tokenized finance, AI-driven commerce, and the movement of value across a digital economy. Whether you agree with every prediction or not, one thing is becoming very difficult to ignore. The conversation around crypto has changed dramatically, and the next phase of this cycle may end up being much larger than most people currently expect. If you enjoyed this video, make sure to like, subscribe, and turn on post notifications so you never miss our biggest crypto and macro updates. Thanks for watching, and I'll see you in the next one.